Hello and welcome to this fresh new edition of Mutual Fund YouTube Corner. Still in the festive mode, so it's a good time to get understanding more about your investment portfolio in the mutual fund space. And we have the expert joining us, Harshvardhan Roongta, CFP Roongta Securities, to detail all of that for us as well. Harshvardhan, thank you so much for joining us as always. And we have spoken about it in the past that yes, there are returns in mutual funds, but with that comes some risks as well. So let's start the show by understanding what are some of the risks which are associated with mutual fund investing.
Hi, Sonal. So I'll divide this risk that we're talking about into two levels. One is a fund house level risk, and the other is external risk. Now, external risk would essentially mean systematic risk, such as market risk or interest rate risk. So this external risk essentially is common for all fund houses. So we can't really differentiate different fund houses based on that. But let's talk about the fund house level risk. So when an investor wishes to invest or create a portfolio for themselves, what she is going to do is trying to look at the fund house and the schemes. So how do you differentiate? How do you pick? So there are certain factors that investors could look into. The first one, of course, being a concentration risk. So whenever you're picking up any scheme or a fund house, you would need to look into how much allocation is there of that scheme into a particular sector or particular set of companies. So that is a concentration risk because your purpose is to diversify. You would need a portfolio which is well diversified. The other would be a liquidity risk. So liquidity risk essentially would try and say that if you invest in a particular scheme, how easy it is for that fund house to handle the redemptions. If there are unexpected redemptions, how easy it is going to be for that fund house to liquidate and honor my redemption without having to sell at distressed prices. So, there are a few things that you'll have to keep in mind. The third one you have to look at is credit risk. Now, credit risk, if you're a debt fund investor, you're investing into a debt scheme, very clearly you would know what kind of papers are being invested into. Is it a AA? Is it a AAA? Is it a B? So all that ratings is going to be there. So you might want to just have a look at those papers so that you can get an idea. Now, the fourth one that you need to look at a management risk and also an internal risk management processes. So you're aware that all individuals, all fund houses, all fund managers for that matter would have their own investing style. So, you have to evaluate the fund manager in different market cycles. So somebody may be a growth-oriented investor, a fund manager who's done extremely well only in bull runs. But what about cases where markets fall? Is that fund manager able to handle those falls also equally efficiently, or is just a growth-oriented fund manager? So you need to look at that part. The other element that you need to look at is what are the internal risk management processes of fund houses, which is not known in public domain, but that's basically the nervous system of the entire mutual fund industry. When they do the risk assessment and they decide or they approve or not approve a particular paper to be included or investments to be made. So I think it's a combination of several factors that you need to put together and then create a portfolio for yourself.
Okay, take that point. So out of the number of risks that you have mentioned, Harshvardhan, what would be the most common thing that people usually avoid, but it's right there?
Well, Sonal, unfortunately, while we spoke about all these parameters, none of these parameters are looked at by retail investors. All that a retail investor would do is look up some on a website and see how much returns have been generated over the last 1 year, 3 years, and 5 years. I mean, that's not a very good indicator to decide a selection of a scheme. There could be several factors affecting returns in the past. Now, that has nothing to do with the fund management or the team. It probably would not have anything to do with concentration risk, etc. But, unfortunately so, the only parameter looked at by retail investors is how the fund has performed. And past performance is not an indication of anything that is going to come in the future. So what you need to do is look at parameters. What is simple to look at is, of course, things which are in public domain. Now, you could look at concentration risk. It is easy. You just pick up a fact sheet and you will know what is the kind of investments and what is the allocation that each team has towards each sector or company. You could look at probably the credit risk that I spoke about. So these are some things in public domain easily available, which an investor should look at.
Okay, take that point. In addition to the standard risks that we just spoke about, we spoke about fund house level risk as well. Fund selection risk is one of them. How do you explain that?
Oh yeah, so I mean, we are in a space and zone right now where mid caps, small caps have become the flavor of the season. You see the AMFI data which says that the kind of flows that are coming into the small cap funds is not something which is at comfortable levels, at least for people who understand what's happening. Now, if you look at investor profile, so if an investor is equipped enough to do this analysis that we spoke about, we spoke about certain risks. If an investor is equipped enough to look into those risks and decide what to do, then you can look at active funds. If you are a do-it-yourself DIY kind of a direct plan investor where your objective is to save costs, then I think you should look at passive funds, because then you're eliminating all of this, the concentration risk, you're eliminating the fund manager risk, you're eliminating all of that, and you're simply investing into an index which is low cost. So I think you need to decide what kind of an investor you are, what access you have to good advice, and then possibly decide that how do you want to go about creating a portfolio. There's no right and wrong. Whatever suits you is the best.
Okay, so say in case a sector is doing really well, a particular asset class is doing really well, does putting up all the money in that particular asset class or fund make sense, or do you think that would also be a risk?
So, well, Sonal, sector funds, for example, are for investors who can track that sector. So if a person is well equipped with probably what is happening in the IT sector, the information technology, he's been in a technology background and he understands what is happening in the IT sector, then you would need to time your entry and exit, because that's the entire idea of investing in the sector fund, that you want to, every sector is going to have its golden period. So if you say that the sector is going to look good in the next 1 or 2 years because of XYZ factor, then you would need to track those factors playing out. The moment those factors are played out, then you would also want to exit out of it. So timing your entry and exit in the sector fund is going to be important. You need to know why there would be changes in that sector or how the sector is going to benefit, and then you need to do that. Now, of course, we spoke about concentration risk. Now, in a sector fund, as the name says, you will have companies in that operating in that sector. Only those companies are going to be in your portfolio. So you can't really do away with the concentration risk. All you need to do is move out of one sector at a time and then go into another sector. So you need to do that bit yourself. If you're good enough to do that, great. If not, then probably a diversified fund would be a better option.
Okay, so that boils down to one thing. We need your expert opinion in this. How can one combat all these risks that we just spoke about?
So I'll tell you, Sonal, there is one golden rule saying that the only way to mitigate risk is to diversify. Okay, so you cannot, because I cannot estimate what's going to go wrong in a particular field. And so what I do is I split my investments and put them across different fund houses, across different schemes. So not that I build up a portfolio of 10, 20 companies and 20 schemes. I just need to diversify across fund houses, because as I said, each fund house will have an internal risk process which is different. The fund manager style is different, etc. So you'll have split your money across different fund houses. And at the same time, you will pick schemes, one of a large cap, mid cap, small cap. You'll pick different schemes so that at different times, the different categories will perform differently. So overall, you've diversified, you mitigated the risk, and you're then coming into the markets, which I think is the only strategy of handling risk, is to actually diversify.
Okay, diversification is the key. Harshvardhan, always a pleasure speaking with you and getting your opinion on the mutual fund investing side. Thanks a lot for joining us today.
My pleasure. Thank you so much.
Okay, all right. That's curtains down on this edition of Mutual Fund YouTube Corner. Stay tuned for more news and updates.